So today we're talking about directional, meaning I think it's going in that direction or that direction, swing and day trading. And I hope we have some swing and day trading. What's swing trading? I'll explain that. Day trading, I think everybody knows. You're in today, you're out today, and so on. But the strategies that we will use for either swing trading or day trading are essentially the same because all we're doing is changing time frames. The concepts are the same, the analysis is the same, but we have to choose different time frames for what we're goals are after. So a little bit about myself. I won't spend a lot of time. I'm doing this going on close to 40 years. Yeah, I'm older than probably many of you, but started out knowing next to nothing, pretty much. So maybe some of you are sitting in that seat. Eventually I met a fella. Actually, some of you might have read. I went to a trading group run by Alexander Elder. He had a still well-written book, Trading for a Living. It was pretty popular many, many years ago. And he had a trading group where I met money managers and market makers and specialists. I was in awe of the people that were in the room until I realized they didn't know too much. They were all on order flow. They didn't know too much about technical analysis, and they struggled just like we all do for different reasons. 1994 started one of the first fax letter services. Yeah, we had tons of fax machines going out all night, a hotline. First online chat room ever. You couldn't talk, but you could type. Eventually, talking became available. Had an office several offices around the country. People came to trade, did hotels, recorded seminars, owned a brokerage firm, sold all that 2015 to another company. They begged me for it. I said, okay. Used to do trading challenges. Those shows have become kind of software displays and brokerage firms there. But as I said, I eventually started teaching hedge fund managers and market makers and specialists, prop traders, everybody. Probably most of the people you come across that are teaching on the internet has been a student or a subscriber to a letter at some point in their development. Some of them are listed on my website, so you probably know some of them. You can check that out. This is me, the guy in the middle. Thinner, a little more hair. First trading expo back in 1999, teaching traders training, trading, and technology. We called it the 3 T's. You can see that was the booth back in the time, and that was the old company. Pristine Day Trader, Pristine Trading, and Master Trader was actually a brokerage firm, one of the first online brokerage firms ever. And then when I sold all of that, I kept the URL. It was a great URL, or what I do now, which you can check out the website. So everything's the same. I learned a lot over those years. I still learn things today because market environments change. The fundamentals do not change, but market environments change, and you have to have ways to go with that. So let's see where I'm at here. Part of my development was the same as I believe majority are, which revolves around the indicator-based methodology. Stochastics, MACDs, Elliott wave, little GAN splashed in there for enough brain damage. There were no Ichikumi clouds back in the day. Some brilliant individual created the ultimate indicator. And through a process of trying to find out the right settings and right indicators, I realized none of them work. They were misleading. They were confusing. I was ready to give up. Last ditch, remove the indicators, see what the hell happens. Scared to death, right? What am I going to do? Hello, this is right. Hello, McFly. Remember that movie, Gone Back to the Future? He's banging the guy on the head. Hey, McFly. It's like, holy crap. It's all there. It was all there in front of me. It's the price action. It's not the frickin' indicators. How do you develop a method to just focus on price? Well, you start with recognizing price is king. Everything else is secondary. Look at it in a candlestick format. Why? Because it creates pictures. Right? Bars create pictures, but candlesticks create better pictures. Are they magical? No. Trend analysis. Get rid of the trend lines. Get rid of the fib lines. Get rid of channels and Bollinger Bands, and create a method that's objective by following the trend that's black and white. Multiple time frames. This was one of the giant hurdles to overcome, because when you change the time frame, the pictures change. When the pictures change, it can become confusing. So it becomes an art in of itself to read multiple time frames and how to combine them. But you can't look at too many time frames. Otherwise, you run the risk of analysis paralysis. So you have to choose. It's not to say there's a right and a wrong, but you have to make a choice. And as we'll discuss, if you're a day trader, there's no damn reason to be looking at weekly charts. Not intraday, that's for sure. Right? Support and resistance, how do you define that? Well, it's not with VWAPs, it's not with fib lines, not with trend lines, it's not with any of that other esoteric stuff. And I've said it once, I've probably said it thousands of times over the last 25, 30 years. Look to the left. It's support and resistance is right there on your chart for everybody to see. There's no proprietary levels. That's all BS, folks. It's so simple. It's there on the chart to see. Relative strength and weakness. What does that mean? That just means X is going up and Y is going down. X is stronger than Y. Well, sometimes X goes up faster than Y, and it's stronger. Sometimes Y catches up. Those are what we call catch-up trades. And the essence of that is money rotating from weak to strong. Money rotates from various sectors and markets to find what we just call it value. Right? Relative strength and weakness, volume, secondary. I don't need volume to trade. Some people make a big deal out of it. I don't. All they need to know is there's enough volume, that's enough liquidity there, especially for a day trader. What are the broader markets doing? It's important. Top-down approaches, we call it. S&Ps are moving. NASDAQ 100's moving. What is semiconductors doing? So you can go from broader market indices to sectors, individual stocks, market internals. Well, market internals and intermarket analysis. This is what I call a three-legged stool. After analyzing hundreds of trades and trying to figure out why is this pattern not working out the same as this other pattern? Well, sometimes it's a different sector, of course, but market environments change. So I needed a method to monitor where I was in the broader markets, right? And how does intermarket analysis work? How do currencies affect commodities and interest rates affect the broader markets? From an investor or swing trading perspective, it's important. Position and money management, that's the 800-pound gorilla that no one really delves into until they get beat up. So many courses, many students over the years, no one is interested. I shouldn't say no one. The majority are not interested in learning about position and money management. You say, why is that, Greg? This is supposed to be like a business, and they don't want to know how to manage money. Nope, they want to know about candlesticks. Can't just talk candlesticks. Everybody wants to know how to manage the money and the position. Not really. After a little while, they figure it out. And this position and money management is tied to your psychology like you wouldn't believe. If you don't believe that, just go place a trade. Put your whole account into something after we're done here and watch how your emotions start to roar. Right? Because the fear of loss, or if it's going the right way, the greed, your emotions will explode. But if you want your emotions to be normal and calm, you learn position and money management. And you have to learn confidence, patience, and discipline. How do you do that? For me, you get rid of the subjectivity. Throw the indicators out the window. Remove them from your chart. You're not going to find an ultimate indicator. You're going to find ones that line up at one time, and they don't line up another time. Then they line up with IBM, but they don't line up with XYZ. You try to fiddle with the settings, the different indicators or combinations of them. Before you know it, you're tearing your hair out. What doesn't change? Greed, fear, supply, demand. People are trading instruments. People are emotional, and the pictures of those emotions are there on the chart. They form pictures. We trade pictures. Right? We were talking about that in MT Live at 12 o'clock. Right? So get rid of the subjective analysis. You need a systematic, objective method of interpretation. It builds a thought process. Right? That's what we're thinking. I'm thinking, XYZ is pulled back to support. What support? Define support. How strong is that support? Is there a way to define it? Is the trend up, down? Is it sideways? Are multiple time frames in alignment? Now we start to build confidence. And theory, school, gives you a certain amount of confidence. Experience gives you real confidence, because as you operate in different market environments and see how market environments change and how you have to learn to change with them, now that seasoning creates confidence. Let's talk about our method. So we need to define a trading plan. What type of trading will you do? We have to define a trend, right? What is it in the time frame being viewed? What changes a trend? Define support, right? Put demand, define resistance. That's where supply is, right? So those words are interchangeable. Or the lack thereof. What does that mean? Aren't there always support and resistance? No. Sometimes there are this idea, this concept of a void. What's a void? Well, there's no support or resistance. How could that be? Prices gap up, they gap down. There's no support and resistance in between the gaps. So that's a void. Sometimes prices rip higher in an explosive move. There's no areas of congestions. It makes a void. We have to define reversal patterns. We define time frames that we will use. As I said, there's no right or wrong. As an intraday trader, you could use 15-minute charts, 5-minute charts, 4-minute charts, 3. You could use tick charts. There's so many choices. What do you use? Someone must have figured out the perfect one, right? Wrong. If you get too close to the price action and you don't have a plan for the price action, you're going to die a death of 1,000 razor cuts. If you're just starting out and you think you're going to trade a 1-minute chart, I say good luck to you, because you're going to see so many different candle patterns coming at you so fast, you're not ready for it. And it isn't even necessary for you to be ready for it. You know, you might find your comfort level is on a 5-minute chart or a 15-minute chart. The patterns work on all of them, and you got to define your position and money management. So, technical analysis. My point of view, these are pictures of others' beliefs and expectations created with money. When you look at a chart, that's what you're looking at. The pictures of others' beliefs that created that chart with their money. They placed trades, and it formed pictures. And so we're price pattern traders. They communicate to us how other traders have acted and what is their beliefs and expectations in that time frame. Just think about prices are going sideways. They break out, and they break out with a big wide range bar that closes near the high. They're confident that it's going higher. They were waiting for that coiled spring to burst and for it to break out. But what if it breaks out and it goes up $2, and at the end of the time period, it's only up 1/4 of a point? Somebody's got some failed expectations. Something went wrong there. So these candlesticks, they speak to us a candle language, and they're based on a continuous thoughts and trading decisions. Now, what kind of trader do you want to be? Want to be a swing trader? A lot of people, yes. I have a job. I can do my analysis at night. I can place my trades. I can put buy stop orders in or sell stop orders. I can put in my stop loss. As long as you use proper position and money management, your stops will be far enough away. You'll be share sized appropriately, and you go about doing your work. You can have alerts on your phone, monitor the trade, put in orders to sell at certain points, and so let it go where it's going to go. Some of you might say, man, I want to be a day trader. I want to be there in front of the screen all day. Well, maybe, sometimes it gets pretty boring. Maybe you do, maybe you don't, but that could be a goal. But you have to have a plan for that. And so, I'm just giving you, my point of view plan, 60-minute chart. After I've moved to like 65-minute charts. Why? Anything magical about that? No, just that it chops it up into equal bars, meaning some. And the problem with 60-minute charts is one platform, the first bar is a half hour. Another platform, the end bar is a half hour. You want to look at what pretty much you think everybody else is looking at. Why the software platforms aren't unified, I have no idea. Sometimes I have to use a 2-minute chart because things are moving so fast. The 5-minute candles don't break things up to the point where I can see the pictures that I want to see, like a continuation pattern. So after that, you start going below a 2-minute chart. You just, you're like in a Ferrari. Things happen so fast. Slow things down. You'll be better off for it. And sometimes you'll miss moves, but the other side of it is with a higher time frame, with a bias from like a 60-minute chart, you will be finding trades that have a greater potential. And you know what? Most that are trading from a 1-minute chart, they're scared to death, because that next bar could be a red bar. And oh my gosh, don't let it be a red bar. Because what that means, maybe it's going to go down against you, and that's you're on a 1-minute chart. Things are moving pretty fast. I mean, I hear people trading off at 30-second charts, but hey, to each their own. Technical analysis is the same in all time frames. I mean, even if it's a 1-minute chart, the patterns form the same on a 1-minute chart as they do on a daily chart. You don't need any indicators. There's no proprietary system. Yeah, there's software. There's plenty of software salesmen out there. And I said, maybe they have their place, but all the information is there on the chart for you to see. You just got to learn the patterns. There isn't a best time frame. I already told you that. It's a choice. Bias is the same. Macro time frame, micro time frame. What's the bigger time frame doing? Gives you your bias. I'm not so interested in the candlestick patterns on the higher time frame. I just want to know, is it going up, down, or sideways? Does it have a void to move? And then I move down to the smaller time frame and I look for those pullbacks. So that lighter blue line, that's the macro time frame. It's pointing up. And so in the micro time frame, it ebbs and it flows and it goes up and it pulls back and so on and so forth. And sometimes they go sideways and then they break out. So we scan for these patterns. If you check us out in the morning or in MT Live Wednesdays at 12 o'clock, I show you how to use the software, but I've created many scans looking for wide range bars and breakouts and bottoming tail bars in 180s and so on. So, makes it relatively easy to find setups when you know what to look for. So day traders use weekly and daily time frames. Sometimes they can go down to a 60-minute chart to refine, but really all you need is the weekly and daily time frame. At the end of the month, you could look at monthly charts to see how things look, but that monthly time frame isn't done until it's done. Day traders, I'm saying mine personal as a day trader, 60, 15-minute, and 5-minute. As a day trading requires focus. One of the biggest problems you will have as a day trader is looking at too much. You're one person, right? In a trading room, people have different ideas, but look, as a day trader, you need to focus. You get your list, you know what it is, focus on it. Because if you're all over the place, you're just going to miss trades. You're going to become overwhelmed with too much information. So, resign yourself to finding what you want to trade, value your focus list, and just trade it. Because all you care about is, as long as it moves, you can, you'll find opportunities. Who cares if Tesla's up, 30 points and you're not in it? You're in XYZ and it's up 5 points and you're happy. Candlesticks, simplified. There are big candlesticks and there's little candlesticks. Right? Big wide range bars, big green ones, big red ones. There's narrow ones. There's ones with tails on them. Call them dojis. Call them spinning tops. Call them whatever you want. Wide ranges and narrow ranges. Topping tails. Those are the ones they got a tail on the top. Okay, great. What does that mean? That means sellers took control. It was higher. For whatever reason, it turned back down. And ones with small candle bodies or narrow ranges tell me that momentum is decreasing. Big red candles or big green candles tell me momentum is increasing. So a big green candle coming out of a consolidation, that's an igniting candle. It says it's going to continue to move up. If it's a big red candle breaking down out of a consolidation, that means it's going to continue to go down. Those are power bars. If something is going up, say for 8 bars, and the range expands and it turns into a topping tail, that tells you that there was distribution. And it's like prices are likely to retrace. And the same thing is if they go down and you see the range of the bar, you can have a narrow range bottoming tail or topping tail, but if you have a range expansion bar, what's define range expansion? It's just bigger. It's just a lot bigger than the bars that preceded it and whatever you're looking at. So if you were trading Beyond Meat, which looks like it's going bankrupt, you would notice if it's got a big bar. But if you're trading, Amazon, obviously a big bar is going to be points versus, whatever it is. So it's just common sense. Compare it to whatever you're trading. Keep it simple. Candlestick hype. There's all the names. Bullish engulfing, bearish dark cloud covers, whatever, tweezers, divisions. Who cares about all of that stuff? Right? Is the bar expanding or is it contracting? What is the trend? Is it near support and resistance where this contraction is happening or these bottoming tails or topping tails? Now, here was a big light bulb moment for me, because when I started out and I started to learn, there were no candlesticks when I started out, by the way. You might find that to be unbelievable, but the data wasn't available to have opening and close. You had the close, but there was no opening price. So back in that time, we had to re-download all the data where you could have candlesticks. But as you start to learn about them, as I did, and you say, oh man, that bottoming tail candle works really well. Yeah, it does. And then I'd be waiting for my bottoming tail candle, and it didn't happen. I start changing time frames. It's like, oh, the bottoming tail candle was on the 7-minute time frame, not the 5-minute. I'm making stuff up now, just to give you the idea of what I'm talking about. And so now the next day it would be on the 6-minute or whatever. Before you knew it, I had 10 different time frames going, trying to see the bottoming tail candle. It's going crazy. And then the light bulb moment came. It's like, this is about retracements. It went down and it went up. And depending on the time frame you're looking at, if I compress it, it was 1 candle. If I expanded the time frame, it was 2 candles. It went down and it went up. And if I expanded it further, now it was a 3 candle reversal, and it went down and it went up. In all instances, it went down and it went up. So call it what you want. It was a reversal. Still, what do I do with that? I have to put it in the context of a trend, support, resistance, multiple time frames, relative strength and weakness, that slide that we looked at. So we just have some foundational patterns, pullback patterns, where on the left side there, they pulled back over several bars. And so in the top ones, we assume they're in uptrends. The bottom ones are in downtrends. And as it reaches some resistance point or some support point, it makes a turn. Now, I'm just showing you these, but what if, and I know this platform has drawing tools. I'm just like, what if this red bar had a long tail on the top, on the bottom of it? Does that change your view? It should. Because what that means, it went down and it came all the way back up again, which means that there was strong demand down below. And that range expansion candle said that there was a little bit of a climactic sell-off and things turned back up again. That increases the probability of a pattern. This one here has a bottoming tail. It went down and it came back up again. So this is a retest pattern, retest and failure, looking for it to move back up again. Flag patterns. These are momentum moves that create voids, and it just kind of flags. You know what a flag looks like, a flagpole, and it waves, right? It just kind of drifts lower, right, which is still bullish. And then bases, they can form in many, many different ways, right? Where it's going sideways and you look, you're going to buy a breakout. A lot of times this will just have a big run up, creates, there's no support below. It doesn't pull back where you're looking for this kind of pattern maybe, but it's gone too far to pull back the support, so it creates a base and it moves up from there. Money bars. So this 1, 2, 3 pattern, forever we traded these 1, 2, 3 patterns. We still do today. What's a 1, 2, 3? Big wide range bar igniting a move. You get an inside bar, and then it trades above the bar, the number 2 bar, and it comes out of a base. And it's not like it's been going up for a long time. Now, what would happen, and I'm going back to the 90s, how would we would trade these things? 1, 2, 3. And we'd put the stop under the narrow range bar. Okay, it worked back then. So when it would take out this bar as high, and sometimes it would take it out and come back down again, get stopped out, and I see it flip back up. And I'm reviewing my trades. And it's like, look at that. That's a new picture for me back in that day. It went down, it took out the stops, and it came back. There are people lurking down below, and they drove it back up again. There was like a shakeout. Who was getting shakeout? It was you, Greg. You sold that down there. It took out the stop. And I'm like, whoa, this pattern is even better than the 1, 2, 3. Because of that shakeout, the idea behind it is it removes supply. How does it do that? Well, if it's going up, right, and this picture is one in which it displays a belief that it's going to go higher, it was created by people buying. People buy because they want to sell higher. Well, what if this happens? And some of them have their stops under here or a little bit lower. People put stops in arbitrary places too. So stopping out means it removes supply because they would have been potential sellers. So that's an addition. So now when it takes it out, it tends to have a very nice, explosive kind of a move from there. Right? And so they can happen if this is, the first move and then the second move, so this would be what I would call a continuation pattern. Right? This is your starting pattern because it's coming out of a consolidation. So again, different price patterns. Right? We're reading what others are doing, support, resistance, are there shakeouts? Are there these wide range bars igniting a move, these power bars? Do they follow through or not? Right? So support and resistance, let's just take the mystery out of that. And this is, how we define minor and major support. Prices are going up and They go up, they take out the prior high. We call that minor support. Right? It's beyond what's directly to the left. This would be major support down here. And so we just continue to do that. And as prices are going up, they pull back into areas of minor support. They eventually move back up again. Sometimes they form little topping tail bars. Topping tail bar didn't go down. Oh, buyers are still there. Strong. Notice this one had a little gap down, came back up again. There are buyers on dips. And so it makes another new high, minor support, major support. We continue. Pull back, another new high, minor support, major support, push up again, major support, pulls back, goes up, raise major support. So now we have higher highs and higher lows. If it violates major support is the low prior to a higher high. It's going to violate the uptrend. It's no longer in an uptrend, black and white. There's no ifs, ands, or buts about it. Now, if you start connecting dots and start connecting dots to make trend lines, what you'll find is many times it breaks the trend line, but it doesn't violate major support. It's misleading. You think the trend's broken. It's not. But if it breaks major support, it's going to break the uptrend line every single time without fail. Bet your life on it. It's going to happen. It's indisputable. So in this time frame, if it violates major support, it's violated the trend. It's no longer in an uptrend. It's in a sideways trend. But what if the weekly chart is still in an uptrend? This has still got a chance to get turned around. We don't know. That's the truth. Now, if the daily turns down and the weekly turns down, clearly it's in a little bit of a bear market. All right, multiple time frames. How do we deal with multiple time frames? Well, sometimes they're out of alignment. They're not always going to be in alignment. We do the best we can with it. But if they're aligned, that's going to be great. Right? So if you want to hold XYZ for days, weeks, or months, don't even look at the 5-minute chart. There's no advantage of it for you. Believe me, it'll confuse you. You give up your trades. It's just don't look at it. That's the easiest thing you could do. If your focus is day trading, looking at the monthly time frame, little to no use. Forget it. Moving averages we're going to use as a visual aid. I like to call them visual aids. Why? Because I really don't need them, but if it helps me speed up the analysis of what I'm going to use them in an intelligent way, it makes sense. So we use simple moving averages. Why? Because we have to make a choice, and simple works on equities. If you're trading Forex, most people are probably looking at exponentials. Go look at exponentials. Whatever you want to use, They're not actual support or resistance. Some people, oh, the 200 period moving average, that's like a wall. Really? How the hell did it slice through it like it wasn't there on XYZ? There was probably some algorithm out there. Ha ha ha. No, there was no support or resistance aligned with it, or no one's looking at it. You know, if you're looking at the S&P 500, yeah, everybody's looking at the 200 period moving average. So the ones we use, a daily time frame, can become self-fulfilling prophecies because we use the ones that everyone else is using pretty much. Institutions, 20, 50, 200. Right? Now we can use these moving averages to determine the trend in multiple time frames. I hope you should find that interesting. By looking at certain moving averages, I can tell what the trend is in other time frames. This is how you do it. Right. So I can find out what the trend is and the location of one moving average from another. Calculate the number of bars in the lower time frame that make up a higher time frame and multiply that number by the moving average in the higher time frame. That's the moving average to use in the lower time frame. Let's look at that. Smart moving averages. They're not so smart, just a smarter way to use them. It's not arbitrary. 60-minute chart. 20 MA is the same as a 240 on a 5-minute. 12 bars times 20, 240. We'll just use the 200. Make it easy. Weekly, 10 MA, same as the daily 50 MA, 5 bars times 10 equals 50. Okay. And so on. And so you might have a 20 MA on a weekly time frame. Think about what is that going to equal on the daily? Why don't I use the 100 on my daily chart? Because I got a 20 MA on my weekly chart. That's telling me where the 100 is on the daily chart. So I know. I don't want to put the spaghetti screen on my daily chart. 15-minute chart. 20 MA is the same as the 60 MA on the 5. 3 times 20 equals 60. 5-minute chart. Put the 3 moving averages on there. 20, 60, 200. I know what the trend is on the 5. I know what it is on the 15. I know what it is on the 60. If they're all aligned, odds are it'll be good, either up or down. Daily time frames. I've already told you what I use. 20, 50, 200 is a picture. Right? 20 is rising. 50 is rising. It's above, the 20 is above the 50. The 20 and the 50 are above the 200, but the 200 is sloped down. So when I look at that picture, I know very well that this stock reversed from a correction. But that 200 is a slow moving average. For that thing to be pointing down, this stock had to be going down for a while. So this stock is in recovery mode, but it's a wide range bar breaking out on volume. We're interested. And look at this little breakdown failure here. Right? It broke down and it came back up again. So there's some positive things going on. So yes, the traders can be aware of the trend in multiple time frames while looking at only one time frame. Less becomes more. Well, I know when time frames are aligned or not. And so this chart shows you prices are moving higher on the daily and weeklies. Monthly is turning higher. Right? I said the 200 is equivalent to the monthly. So that 200 MA is equivalent to the 10 MA on the monthly. So the 10 MA on the monthly was pointing down. Are we starting to stabilize? So are they all aligned? No, but it's working on that. So as we start to look at these charts, right? Daily and weekly are down, but monthly is up. You can see that the 200 MA is pointing up. This had been in a correction mode. And we're going to get some of that probably in the beginning of next year because there's so many bullish charts. And so correction. Longer time frame is up. Start looking for trend changes. Traded above major support, the high prior to a lower low. The trend is changing. It even went higher above these pivots by the pullback. And things get a little erratic. It happens, break down and back up again. But here, the takeaway here is to understand where the odds are in your favor based on multiple time frames, right? All right. Price support to the left. What do we have here? Daily, 20, 50, 200. Right? Some institutions buy at the 50 and the 200 MA. Absolutely. They just use those 2 moving averages as a reference point of, is things okay on the intermediate and long-term trends. So if they're aligned with support and resistance, that's a good thing, right? If they're aligned together. So down at the bottom where that circling, that green circle area, converging moving averages. The blue line is the 20, the green line is the 50, and the 200 is the red line. So they're aligned with the 20 above the 50, the 50 above the 200, 20 above the 200. Things are turning around down there. Right? So that's what you would see. You wouldn't, of course, we're looking at something at 2020 hindsight, but the takeaway here is to understand that those converging moving averages mean that it had to have been going sideways for a while. To the left of that, the 20, the 200 and the 50 was under the 200 and they were pointing down. So they were going sideways for a while and there was a big turnaround. You can see the gap up. Now we start following the pivots and support and resistance. right? This is what we call the factory work, marking off support and resistance. Is the trend up? Is it up on multiple time frames? Yes, buy pullbacks. Find your pattern. What is it, a continuation pattern? And this is what we do in Master Trader in our advisory letter. We're scanning, looking for these patterns using scanning software or just looking at hundreds of charts, sometimes more, looking for these patterns that'll guide us as to giving us entry points, or maybe even doing credit spreads. We do a lot of credit spreads. So sometimes there's patterns with prices turning around, and credit spreads, put spreads, call spreads are the way to go because things just haven't completely started to turn yet. So here's examples with the 2060 and 200, just looking at one time frame, 5-minute time frame. Same idea, right? But the moving average is pointing up. Is the 20 above the 60? Why the 60? I already told you it's the same as the 20 on the 15-minute. So if the purple line is pointing up, that's the 60, and the 20 is above the 60, that means the 5 and the 15 are pointing up. And if they're above the 200, that means this thing should continue to go up. Relate this to traders, not just the time frames, but traders using those time frames. If the traders on the 5-minute chart and the 15-minute chart and the 60-minute chart are all thinking long, buy the pullbacks, buy the breakouts. Right? It's just common sense. These other lines here, the blue line is the opening price. The red dotted line is yesterday's close. What does that tell me? It tells me that if prices are above those two lines, the daily candlestick has a green body. And if this is bullish, as explained on the 5-minute chart, the odds are in your favor that there's going to be buyers on a pullback. That's what we're after. We're putting the odds in our favor. So we're aware of the trend in multiple time frames. I've showed you how to calculate that. I don't have to explain it again. That's what we do. Green room. This is our live trading room, open every day, 9 o'clock in the morning. I start doing pre-market analysis. We do that on YouTube, Twitter, X, whatever. It streams all of that, or if you're in the room. And we do that first thing in the morning, and we go cover our open positions. But this is an example of what to look for. Just be a minimalist. So trend down, look for patterns, look at resistance. BOF is breakout failure. That topping tail, which is the pivot, is down in multiple time frames. Right. All are up in this example. Wide range bar breaking out. You've got your bias. Buy breakouts, buy pullbacks. Wash, repeat, wash, repeat. We're all sloped up. The odds are in your favor. The right side of the chart, there's a breakdown. It's over. It's broken down. It's over. Here is pre-market data in the same thing, pivot highs and pivot lows. We didn't cover that too extensively, but the software just marks off areas where a pivot high is just a bar with 3 lower highs to the left and right. Pivot low is just a bar with 3 higher lows to the left and right. Almost any software package has it. Some of them call them fractals. I don't know why. You just set it to 3. And so head and shoulders bottom, wide range bar breaking out. There's your 1, 2, 3, 4 setup. Right, bottoming action, right, day trade along. Right. Just explain, as I said, you could do option spreads. If you do 0 DTE, I give levels for that every morning. S&P 0 DTE, credit spreads. We use TC2000. I use TC2000. I've created many, not many, but enough layouts and scans and ways of finding opportunities. These are things that I share with subscribers. If you use it, I have no affiliation with that platform. But if you become a member, I share this with you at like dog and her bone. You can imagine the bone. No extra cost. Right? What I provide you to help you to find opportunities, in my mind, is priceless. I created it, I'm biased, but geez, you know what? If you want to be able to find the trend, you want to find out where the wide range bars are, there are scans within the layouts to help you find wide range bars, 180s, bearish wide range bars, breakouts, so on and so forth.
Hey, Greg.
Every Wednesday. Yes.
Hey, you're welcome to speak to the top of the hour if you would like. If you want to take another 14,
Yeah,
15 minutes.
I was supposed to get on a call, but maybe I'll take 5 minutes or so. Do my
Okay.
best. Yeah.
Okay. All right.
Yeah. So maybe I can show a screenshot of other stuff here, but look, on Wednesdays, every morning at 9 o'clock, if you go onto YouTube, see Master Trader, there's no cost. You just go on to YouTube there and just listen to what we're talking about. Always education. And it's on Facebook and it's on X. So you can check that out. Check out my name on X. But we do, like today we did price patterns. We do option strategies. Every Wednesday is education, and you sign up, you get the replay. And so there's no cost to it. So you'll learn a few things. My offer today, and you can go there, that's the shortcut to it, deals now. Type that in there, or they can put it in the chat. Just go there. You can get in the green room if you want live trading and education all day long on an annual this time of year. It's $1.60 a day. I mean, it's a no-brainer. You're getting education every day. You're getting trades. You're with a group of experienced traders. Some not experienced, of course. There's always the case, but they're like a club. They're sharing ideas, what their trades is. We have discussions. So it's really a fantastic little, great group there. You can check it out. So you've got different courses. We've got, our courses. I got a little time to talk here. Look, when I sold the other company and everything, we had a lot of different things that you could choose from. Some people found it confusing, so I created one course. Master Trader Technical Strategies. Included everything: intraday trading, gap trading, money management, psychology, trading journals, everything. I was like, man, that's fantastic stuff. But you know what, Greg? I can't spend that much, you know? And the best thing is some people would say, you know what? Once I make a few dollars trading, I'm going to come back and buy the course. And I'm like, yeah, ha ha ha. No, I've heard how many times I heard that in the last 30 years I've been doing this. As they say, putting the cart before the horse. You need the education. From the education, you get experience. And you know what? Forget about making money at the beginning. Focus on your development, that you can follow the rules. A method. You have to become accustomed to the rules. And so take it slow is my best advice to you. Do not go down and learn some questionable strategy and start hitting the button on a 1-minute chart. You are going to get killed. And the illusion to the 1-minute chart is that you can up the share size because you think the risk is small, because your stop is tight. If it gets away from you, the bleed is going to start. I'm telling you, been there, done that. Can share a lot of experience with you, because you know what, you made plenty of the mistakes. It comes with it. Your advantage is to avoid those mistakes if at all possible. Human nature is going to kind of drag you into making some of those mistakes, because you're just going to test the waters, which is fine. But test the waters with small amount of shares. I don't care how much money you have. Start off slow, trade 2 shares, 5 shares, whatever it is. You're looking to gain experience. I'm telling you, you will make mistakes by pressing the wrong button. It just comes with the territory. You're going to press the buy button when you meant to press the sell button. You're going to turn the wheel on your mouse. Maybe it's going to increase the shares from 5 to 500. Who knows? I've done it. So you have to get experience in different market environments. You have to gain experience in using your software. You have to gain experience in saying, you know what? I really don't like my candlesticks red and green. I think I prefer them to be blue and red. Or I don't want this chart in the left upper corner. I want that chart in the lower right corner. There's a lot of differences to how you may want to trade as you learn things. So it's a process that you have to allow yourself the time to assimilate this information and what professional trading is about. Okay. I'll show you something else here. I can switch screens. Just a little time here. I'll show you one of the screens here. So you can see this screen, which I would call using for a top-down approach as to what's happening in the market, broader markets, S&P sectors, what's doing well, what well on the day or bad on the day, what's doing well on the week, easy to find. How I moved that, I don't know, but I want to put that back where it was, save a little space. So look what the market's doing today, right? S&Ps are up and Qs are up. Q. Qs are up, outperforming. Why? Because of FANG stocks. Look at this. No FANG stocks. What's going on there? Under the hood, things are okay. They're not great. But if we want to go and look what financials are doing, they're underperforming. Energy is underperforming. Communications are doing well. What's doing well in communications? We can just sort this by what's up on the day. Google. Now, if we want to go and look at S&P 500, now, can I find a bullish 180? Well, look at that. That's going to report earnings tomorrow. So when is something reporting earnings? I just look right on my layout. I know what sector it is. I know what the subsector is. I can look at semiconductors. If this semiconductor is doing well, how about other semiconductors? Are they doing well? Well, look at this. That's in a downtrend 180. We're getting some 180s. We're getting some bottoming patterns going on here. That's not a good 180. That one's not so good. That one's kind of so-so. And we can look at these in multiple time frames. Or if you're a day trader, maybe you want to find stocks that are basing on the 65-minute that might break out. There's a lot of ways to find opportunities. I can show you them. MU, that's not such a good 180. What if I want to find bottoming tail bars? Well, it's in a downtrend. That's a bottoming tail bar. What about a range expansion 180 or any of those? Well, no, there aren't. Well, maybe are there any in the Dow? Nope. Are there bearish ones? Nope. What about in the, let's call here, consumer staples, defensive stocks? What about, is there anything bullish in there? No. What about on the weekly time frame? No. This one has got a volume spike. Oh, this was somebody looking to buy Walgreens. That was in the news. So there was a volume spike there. But what if you want to search volume spikes within the last 5 days? Oh, well, this is the one that's going to buy them. I thought, no. Oh, this is the one Albertsons I think they were going to buy. Right. There's a volume spike. It's below the 200. You see, we're looking for our pictures. And so as we look through these sectors, right, we start looking for things that we recognize. Industrials. See, the FANG stocks are moving. What's moving, right? The breadth is narrow, and I could show you breadth and teach you about market internals, right? But in the NASDAQ, FANG stocks are doing great. So on the week, let's see what's doing week. Oh, that's a software application. But we can find what's moving and what's not. Right? So this is the work we have to go through till we start finding patterns. Right? This here's one bottoming. But by looking at these layouts, we can find what's doing well, right? Or not. Right? Semiconductors are doing well today. This is a different semiconductor. There's XSD and there's SMH. So this looks like it's going to break out to go higher. We can now start looking at stocks within that sector. This one's already going up. So this is the work that we do at Master Trader. We search these. We have the advisory swing and options letter, focuses on swing trades, either buying or shorting the underlying or using options to trade them if they're liquid. Weekly options trader letter, just weekly options credit spreads. That's all that does. Credit spreads, usually with expiring within that week or maybe a little bit beyond into the next week. ETF letter just focuses on ETFs. And of course, all of our courses are about teaching you swing trading, how to trade options or ETFs, position and money management. So important. And I think that's it for me. But guys, come to Master Trader. You can check us out on YouTube and Twitter and all of that. MT Live, free every Wednesday. Like I said, I've been doing this almost 40 years, and we can share a tremendous amount of experience and education with you.